Good morning. This is Jim Riggio and Tom Nunemaker. This is Capital Discussion Roundtable. We're going to be talking about the VolVantage trade and taking a look at the VIX and VIX futures and options today. But before we get started, quick disclaimer: Capital Discussion is not a broker-dealer investment advisor. The presentation about to see is for educational purposes only. We have no way of knowing what level of risk is appropriate for you and not making any specific trade recommendations. The risk of trading options and futures can be substantial. Please be aware of all risks prior to placing any trades. Computer simulated trades are believed to be accurate. However, due to such factors as slippage, commissions, and liquidity, your results will vary. So, Tom, one of the things that I wanted to end up going over is that we've had some really interesting things going on in terms of the volatility market, and so I kind of wanted to end up going over them. But quickly before we do, I did want to end up sharing for those of you that haven't seen the VolVantage trade before, what we're actually looking at when we end up looking at the VolVantage trade. Basically, I had been involved in two different, very long, drawn-out studies on how to look at VIX options and the ETFs and ETNs that surround them. Okay. Just as a quick recap for everybody, right? The VIX is a calculated index created by the SIBO back, more than 20 years ago, and it looks at near term. They define near term to be 30 days out, so it's always looking at 30-day options. They normalize the options because there's usually not a 30-day expiration, okay, every single day. So the way they end up doing it is that they just normalize it. It really is the de facto standard in the market. Couple of key things, though, okay, is that it's a calculated index. It can't be traded. So there is no cash price. Yeah, you can end up quoting it. Some people will call it the spot price, but there is no way to actually end up trading it. There was great demand, okay, in the early days to be able to buy or sell the VIX. So what ended up happening in 2004, the SIBO came up with VIX futures. They came up with the SIBO VIX futures exchange, is where everything eventually ended up trading, and they ended up having VIX options. Now, the VIX options are not options on futures because that would end up being considered to be a lot more regulatory. It would end up being underneath a different regulatory body, the CFTC, and they didn't want to end up getting into the whole futures thing. So the VIX options actually price off of on expiration, they settle on the VIX cash or spot price as it's calculated, but they're actually priced off of the VIX futures while they trade during the life of their trade. They just settle on the VIX price. That's a really important thing because that means that there's no way to arbitrage the VIX options and the VIX futures. And that becomes a really big thing. So what ended up happening is that the products were used by mostly institutions, and it wasn't until the 2008 crash, excuse me, when there was such huge retail demand that products started to come out that were based on them. And that's basically a quick overview of the VIX, the VIX futures, the VIX options. What ended up happening in 2008, there was such demand after the financial crisis that many ETFs and ETNs came out. Just so that you know real quick, because I get asked this all the time, an ETF is you will actually have the VIX futures in a actual ETF, in an actual security. The ETN is actually underwritten by the creator of the ETN. In the case that when we're going to talk about, it's Credit Suisse. And what ended up happening with Credit Suisse on this is that instead of actually trading them, they actually create the product, using other contracts and other I'm going to call them, they're off counter, right? It's not, they're not over the counter. They're actually custom, okay, securities that they'll end up building with a and trade, okay, in an institutional environment, and they end up underwriting the whole thing. Now, what they do say is that they tell you how they price it, which is exactly the same as the ETF. It's just that the underlying company ends up actually trading it, and you don't actually own the securities, meaning the actual VIX contracts. Because if you did, one of the things that all ETFs end up having is that if you have enough contracts, and there might end up being something like a million or 100,000 share limit, but you could end up taking a million shares of, let's say, XLF, and ask, okay, the company, the provider of it, iShares, to saying, hey, here's my million shares of XLF. Please give me each of the individual financial companies that this is made up of, and that you can end up exchanging them. In an ETN, you couldn't end up doing that. Okay. Other than that, the only other difference is that. All right. The first and most obvious difference is the risk factor that if Credit Suisse goes out of business, we're just an unsecured shareholder. But what ends up happening long before they would go out of business, if you were in the VXX, you'd have to end up selling it beforehand. The price of it would go absolutely crazy, I would imagine, if the financial markets got to be in such turmoil that a company as huge and as conservatively managed as Credit Suisse was anywhere close to even being considered to be able to default. The other big difference is that if you use an ETF, your taxes are a lot more complicated because now you have the actual contracts underneath. Some of them are going to end up being 1256 or different types of contracts, and you're actually paying tax on the actual trading instead of when you went in versus you went out. It's just a mess, okay, for at least from my perspective. I would much rather own the ETN. If anything gets to be even the slightest whiff of, oh my God, there's financial crisis, okay, that could end up spreading to Credit Suisse and Switzerland and that whole, then I would end up switching over to the ETFs. But until then, I always trade the ETNs because it's simpler. Okay, so hopefully that puts that whole set of questions, okay, to death. What I ended up doing is that I looked at all of the different ETNs. I had been in two different institutions that we ended up building trading systems around these things. And a couple of years ago, I ended up looking at just, instead of trading, the options on these things, the options on the VXX, or the XIV doesn't have options, but the UVXY and the others, I looked at saying, there's just too much uncertainty. What ended up happening, so that is that we've gone through, I'd say, three different iterations of the market. Okay, the first one was when these products first came out in 2010. Okay, end of 2009. Okay, for the VXX, the rest were in 2010 and later. They were priced like they were just normal securities. They were priced as if you could buy or sell the underlying, and which you can't, and everything was priced, if you will, normally. The challenge, and I've gone through this in other videos, I'm not going to go through it now, is that because of the drag of contango, which means that every single month, okay, these guys, every single day that they're having to sell front month and buy back month, and usually they're selling at a lower price, buying at a higher price, that price of contango drag wasn't calculated properly. Okay, and they didn't realize how badly the drag would end up being. Okay, before that actually got calculated, what ended up happening is that you were able to end up going and buying a VXX or UVXY put. I didn't care where you bought it. If you bought it in a long enough term, you made money. We looked at trading butterflies and debit spreads, and what we found is that as low as we would end up going, if we were going out far enough in time, we could never even as far down as you'd want. If we bought a put spread, I'd make money on my long put, but on my short put that I sold way, way, way below the money, I was losing money because the market would go down so much. And so they thought that the options were just mispriced. And so they went through a whole series of recalculating how the options had to be repriced. Then what ended up happening was that the options got repriced a second time because the contango drag was much more than they ended up thinking. So it was like because we're using like a fifth level derivative, right? You have the VIX, you have the VIX futures, you have the VIX options, you have the VIX ETFs, and then if you had options on the ETFs and ETNs, you were at a fifth level already. And so the slightest miscalculation in one of the lower levels ended up just getting increased by orders of magnitude as it went in. And when they ended up fixing these things in two different occasions, okay, the pricing ended up changing directly. So pretty substantially. So what I ended up doing is I said, I don't need all that complexity. Let's make this rather simple. Let's either buy the long VIX ETN or the short VIX ETN, and that was it. And what I found was that there were too many times in the middle that I was getting whipsawed. So I did need to end up having a buffer zone or a safe zone where I wasn't in either trade. Okay, and so the VolVantage basically is a three-state system where I'll either be in a long ETF, a long VIX ETN, or an inverse VIX ETN, and that was basically it. I had just gone through this is just to end up showing you a couple of things where we ended up having the actual prospectuses of all of these ETF and ETNs we had gone through. We took a look, and the stated objectives of these things is not anywhere close to what they actually perform on because of these daily resets and the contango drag. And in the case of the inverse, you have something also known as inverse drag. So what ends up happening is that these ETF and ETNs perform very different than the way most people think. I have seen and I've had friends who were told to end up buying, the ETFs or ETNs as a hedge against a portfolio. And when things are moving well, it's like the worst thing in the world. You have to truly understand how the VIX and how other factors, the VIX futures going out in their term structure, how they end up actually affecting, the price. Okay. Any questions at a high level on this? Because I'm going to end up. That's all I wanted to do. I just wanted to kind of end up doing a relatively quick intro on this thing, and so I want to end up actually getting into the trade. Okay, Tom, if you'd keep your eye on the chat if there are.
Yep, will do.
Okay, great, thank you. Okay, so let me get out of this. Now, let me close this, and let me get into. Let me detach and bring over. I didn't have the one open that I wanted. I had everything else open except for this one. Oh, you know what? It's old, but I'll end up showing you. It's what happens is that the market has moved on. But what I wanted to end up showing is that I started to end up trading this, and shared it with the Kevlar guys back on this date here, which was the 22nd and the 23rd of November last year is when I first got into it. It was after the elections. Things ended up being a little bit smoother at one point, and we ended up getting into the VolVantage trade. Now, what I'm looking for, and the way the math works on these things, is that you don't want to end up necessarily buying the VXX or the XIV when a lot of people think that you probably should. I remember when I first started to talk to some of my Wall Street buddies that I end up having breakfast with every Sunday, retired Wall Street guys. The VIX on this day was about 12.5. And I was going into an inverse VIX ETF. And so basically I'm shorting, right, in because they weren't options guys, right? They were floor traders, they were upstairs traders, they ran trade desks. Um, they end up saying to me, and also they were from Brooklyn, so you'll have to end up excusing their language, but they'd end up saying, what kind of, effing idiot would end up, shorting the VIX when it's at 12 and a half? And the fact is that when everything is smooth in the VIX, okay, and meaning the VIX futures, the way, and all of the different indicators that I ended up looking at, you have a chance to be able to end up having a long ride on an upward slope of the XIV. And that's what we ended up doing. We ended up getting out, and on this chart, I guess I ended up losing where I ended up having, but we ended up getting out for a 59% gain on our initial shares. For those that didn't end up joining, there were a couple of other points where I could end up adding additional trading shares, and I sent out those. It's because all of the indicators that we end up using ended up making sense for us to end up getting in a trade. The XIV trades tend to end up being longer in duration. They grind up because the VIX stays flat for any period of time. There are usually signs, okay, when the VIX futures are starting to change, and there is potential jeopardy to the XIV trade. Let me give you an example of just the XIV trade. If I come over to here, okay, if I take a look at this period right in here, okay, you can end up seeing whatever this was, about 18 months ago. If there was a huge drop, okay, over just a couple of days. But what ended up happening in this area is that the term structure, meaning the VIX of the first month versus the second month, going out, as far out as 7 months. If you take a look at put skew, if you take a look at things like the volatility level of the VIX options, kind of like the VIX of the VIX, if you will. What ended up happening is that there are many clues that you need to end up getting out. What ends up happening often is that you may end up getting a pullback, but if there aren't any, I use the term elephant footprints, okay? If the institutions aren't changing the volatility of the longer term options versus the shorter term options, if they're not doing anything with skew, if their sentiment isn't changing a lot, there's no reason to end up getting out of a trade like this. And you can end up seeing here, this was a day trade, but here's where I ended up getting in. I sold out some trading shares here. These were more trading shares that I bought. Here was the second trading shares that I ended up getting out. Now, here's a very interesting point, and I had been asked this a lot. When I had this pullback in the XIV, why did I consider this a buying opportunity when I had a similar type of pullback here? Why did I end up getting out of my shares at this point? And the answer is, it's because of the indicators that I end up using. I use 5 different calculated indexes, and they're all just using things like, the VIX futures, a different term structure. I end up looking at the put skew. I end up looking at the VIX cash. I look at the VIX options, and basically when I end up having confirmation, okay, I can end up seeing when there are particular opportunities to end up getting either long or short the VIX ETNs. Okay, when we continue to have this sell-off, let me end up showing you what happened over here, because this chart I do end up having. Okay, what you're looking at on this chart in the bar chart or the candle chart that you see on the bottom here. This is the actual spot price of the VIX as it's calculated. What you see in this rainbow or spectrum colors is you're looking at, when you started blue going all the way to red, you're looking at the shorter term options versus the longer term options. So the blue in this case was the April, contract, which ended, by the way, on Wednesday. So we were looking at April, May, June, July, August, September. Okay, so we're going out these 7 months. okay, that we can end up seeing, including in the cash. And when things look like this, right, very, very clean, and I have confirmation on the VIX options, I have confirmation on the VIX skew, I mean not the VIX skew, the SPX skew. It's a wonderful time to end up staying long the XIV, right, the inverse trade, because what tends to end up happening is that that contango roll that cost you so much money just eats away at the price. Now, when I talk about contango roll, I'm actually talking about two things. Okay, the first one is, and let me show you this in a daily chart. Okay, I could even probably go out 6 months. Let me go out. If I can. Okay, not all of them. But what tends to end up happening is that over time, the potential of having the VIX really spike higher, it goes down when the markets are calm. So there is this long-term effect that we're going from upper left to lower right on the VIX futures. Because don't forget, this blue line here, it represented the April trades. So in here, okay, in here, it was the front month. In between here, it was the second month. In between here, it was the third month, and so on. So when I'm out here, it's like the sixth or seventh month. And so the sixth or seventh months tend to always be higher than the front month. So you get this long-term descending slope on the VIX futures. So couple that with the fact that every single day I'm having to sell some of the front month and buy the next month in order to end up keeping my average duration at 30 days, you tend to end up getting this contango bleed. Some people will call it bleed, deterioration. I don't care what you want to end up calling it. But if you take a look over a long term, and let's take a look at a longer term view of the XIV. I'm sorry, of the VXX is what I wanted to look at. Let me go and pull that one up. Okay. Let me bring this over to here. And let me take a look at, and I'll get rid of this, right? Because all this is just, this is the VIX. I'll leave the VIX on. Okay, so the blue line on the bottom here is the VIX. What you're looking at over here is the VXX, okay, going back just to late January. If I look at the VXX over a longer period of time and not just 3 months, let's go out to 6 months, what you start to see is you do get this tendency for it to end up losing value over time. It does have some pretty significant spikes, like if you take a look at the spike going into the U.S. elections, okay, it can move up, and it can move up very, very quickly. It tends to end up, moving up the opposite of the market, right? It tends to end up moving up very quickly, and it tends to deteriorate over time. How bad is this deterioration? You're looking at 6 months. If I go and I take a look at 9 months, it gets even worse. If I go and I take a look at a year, okay, it gets even worse. If I go and I take a look at the maximum that they end up having, look at what's happened here. And let me go all the way back. Okay, from when this thing first started to trade at the very end of 2009. Split adjusted, this thing has gone from 9,000 to 17. Okay, and I don't know if the algos end up working on this, but sometimes let me come over to here and see if I can just, they do work sometimes and they don't in others. When I take a look at price, is it algorithmic here? Using log scale. And it just takes a while. Thinkorswim is pretty slow on this. Anyway, so when it recalculates the log, what you'll see is that it's a pretty steep slope, a pretty straight line, although you do end up getting these bumps like we ended up having here. If you remember this was the debt ceiling crisis. You'll end up getting where it can end up jumping up, 200% in a short period of time. So it's difficult to end up shorting, right? You can end up shorting this. You can take a look at coming out of the financial crisis, where we go from 4,000 up to 9,000. It doubles there. In this place, it ends up coming from about 1,250 up to 3,800. I mean, that's tripling. Okay, in there, and you'll find places where this ends up happening, and you don't see it in here because of the scale. But if I was to end up just highlighting, let's say, this portion, you'll see the same type of thing where it ends up keep coming down. You say, well, it didn't happen during the last 2 years, and if I end up highlighting just the last 2 years, you can see that you still have this same type of pretty serious deterioration. And where, by the way, we do have our logarithmic scale here. So let me go back to the long term. Well, we have the logarithmic scale, and I guess it's only calculating it in the short period of time. Anyway, this becomes rather dangerous, okay, for you to end up taking a look and trying to short it because of the potential losses on it. It makes the calls very, very expensive because it can end up jumping at any period of time. We've tried to end up doing things like, well, hey, if the calls are so expensive, why don't we end up, writing covered calls? Because the deterioration of this thing, you can end up losing so much money that even the money you make off the covered calls won't end up paying for it. So it can be extremely challenging. Okay. When I take a look at the XIV on it, one of the things that ends up happening, and let me come on this over a lot, right? This one started trading near the end of 2010, and you end up having these run-ups, but not nearly at the same level that the VXX dropped. Okay, the VXX drops at a much, much faster rate, and that's because of something known as inverse drag. And inverse drag, okay, if you buy, and this happens with any inverse ETF that you buy, but the inverse drag will end up hurting you with two very specific things, okay, that will make it worse. Number one, how big of a percentage move do you have on a daily basis? And two, what is your longer-term reversion to mean characteristics of the underlying? And because we're looking at VIX or front-month VIX futures, the percentage move is absolutely huge. And the long-term reversion to mean of the VIX is probably unparalleled by any other index, that you can think of. And so these two factors make the drag, the inverse drag, so much greater. And that's why if you try to end up short, along with the fact that it's short versus long, and when you're shorting, you can only make 100%. You can make more than 100% when you're long. These two factors, along with the short versus the long movements, end up making the VXX a very, very difficult trade just to put in your account and just hold it. Because if you take a look at what happened here from July to our lows that we ended up having in 2016 in February, here we went from 50 down to 15. Okay. It's kind of difficult to end up, holding a long-term investment, okay, when you can end up having, 75% drawdowns, which this can end up having. Even worse, if I ended up showing you what the calculations would have been if you would have held this through 2008 into early 2009, you'd end up losing like 95% of your value on this thing, on pullbacks. So you can't just end up being long or short. You have to have some ways to be able to end up getting in or out of these things. Okay, let me close this. Okay, what I wanted to end up showing you is that this all looks normal, right? This is the VIX futures over a period of time. But if I come and I take a look and see what this ends up looking like, let's say over the last 20 days for the 5 minutes, what's happened is that we were in a relatively normal period, okay, coming down until about a week and a half ago. And what ended up happening was, and I want to end up showing you just one thing here. When I put in VX, okay, here are the lines for the expiration. Now, the expirations are different. I wanted you to see that the expiration was on basically the end of day price Tuesday, beginning of price Wednesday, and you can actually see that this is when the VXK, K by the way stands for May, became the active contract. Okay, let me end up coming in here and just getting rid of two things. Let me get rid of um, the extended stuff, and now we can see what's happened over the last. When we get this type of mixture, right? When we get this type of mixture in the pricing, where the VIX futures in the front month, remember this is the blue line. It was the front month that stopped trading on this day. This is the last day it traded. So now the blue line is the front month. The blue line here is May. When the front months start to end up moving up and you get this type of noise, it is signaling that there is potential that we end up getting a sell-off. Okay, what does a sell-off look like in the market? It can be substantial, but you need to end up having other things that kind of end up following through. So what ended up happening, and let me end up bringing up this graph. Okay, what ended up happening here, let me just bring it up. Let me change, because that was here. Let me bring this up to the what ended up happening with the VIX is that when we ended up having so much noise in the futures, the bottom lines, by the way, are similar type things, right? They're just the front 3 months, one rolled off, so now we only have the front 2-month VIX futures contracts. When they started to end up getting higher, there was real concern. Right, there was real concern that there may end up being a sell-off. Now, one of the interesting things that I'm seeing right now is that the front month VIX, if you take a look right here, you can see that's the VX, and you can see this is the VX K. K is the May contract, and then the orange line right here. I'm sorry, the orange line was the K, which was the May. Excuse me, the May contract. You can end up seeing that the blue here is the actual VIX. If I ended up showing you, and let's change this. I want to end up showing you 5 minutes in a little bit different form. Okay, I'm looking at the VIX. I'm looking at the VIX futures front months. The Ks are the Mays, and what I didn't do is I didn't update this because they're the same line right now. So I'm just going to end up moving this to the next month. Right, next month is May, is a M. And this is a new feature that you have to always end up taking the percentages off every time you. And so what ended up happening here, things looked pretty normal, right? If you take a look at where we were, the bottom line here is the futures. You can end up seeing the blue line here is going to end up being the actual VIX. And so really the two numbers, the two ones that I'm looking at are the rose-colored line, which is the M contract, and I'm looking at the contract here where the VX is. And what's happened is that they've crossed over. Right? They've crossed over. They've crossed over going back several days. If I go back further, let me show you. If I go back, looking at say 20 days in an hour. Okay, you can end up seeing that we ended up having this crossover. Okay, and when you have these crossovers, especially not just the first 2 months of a longer period of time, things can end up being rather scary. Now, when that ends up happening, okay, what we ended up doing is that we ended up getting into the VXX trade. It is a quicker trade. It's a trade that can end up making money very quick, but it's also a trade that can end up losing money quicker. And so let me end up just showing you this right here. If I take a look at my trade messages, okay, you can end up seeing that we ended up getting into the VXX trade on the 11th and the 12th, okay, which is about 9 days ago. I guess today is the 7th trading day. And the reason why we ended up doing this is because we had the crossover, we got all of our signals. Now, what's basically happened to the, and if I take you to a daily chart, right, I'm just going to take you to a 3-month daily chart. If you end up taking a look, is we have had since the 11th and 12th, here was the 11th and 12th on the VXX, we did end up moving up a little bit. We have come down. Now, what's happened is that we also had, and this causes a little bit of an issue, we ended up having our expiration happen on Tuesday evening, Wednesday morning. And that always causes noise. And so I was a little bit more tolerant, okay? That's because my trading rules tell me to end up being more tolerant when you end up going through expiration. But here's what's happened this morning, okay? Yesterday, the VIX was, the VIX actually was only down by, the VIX futures front month were only down barely, right? 0.175. The market, okay, was up, and it had a reasonable bounce in the morning, right? I'm talking about this morning that this happened at the opening bell. When you end up having a reversal day like we had yesterday, where we opened up and then we sold off, there was a good chance that selling ends up continuing this morning. It didn't, and so what ended up happening, the market did bounce, but the VIX futures barely budged, okay? Why did that end up happening? I get a report from EAB every couple times a day. And their report, okay, at the end of the day, beginning for this morning, was that there was a huge amount of VIX institutional buying in calls yesterday. When there's such buying in calls, that tends to end up being bigger institutions worrying about a potential sell-off. Does it mean that it's going to happen? Of course it doesn't mean. But does it mean that the institutions are worried about it? Yes. This is so-called, trying to look after the smart money when you end up having a sell-off. And so this becomes a one of the factors that, we always want to take a look at is the activity in the VIX futures and the activity in the VIX options. Okay, and there was a lot of activity. And so when you have this type of level, I wrote that I wouldn't be surprised that if this morning's rally didn't hold, it's continued to come up right now. And so we always need to end up taking a look at the bigger picture. We ended up having a bunch of factors, right? The VIX futures, the VIX options. We also took a look at the term structure. We took a look at the volatility on the VIX options. We took a look at the put skew. And all of this signaled that there is the potential that we ended up having a sell-off. It doesn't mean it's going to end up happening. Usually what ends up happening is that if it doesn't sell off, if the market doesn't sell off within a relatively short period, within a couple of weeks, those factors, if there isn't the same fear in the market, fear's basically subsiding, it's going by, and then we tend to end up seeing that first in the volatility markets, meaning the VIX options, the VIX futures, and that tells us that we need to end up getting out of the VXX trade. Okay. Also, I just wanted to end up pointing out that if you do look at the long term, and it's not such long, but if I'm looking at a weekly chart, we have a clear bull flag that has been formed. If we don't break this level, which is around 23, 25, if we don't end up breaking this level for every day that this level ends up holding and we bounce back up, and if we definitely pierce through the down trend line that's been formed since March 1st, fear will end up going away, and we need to end up getting out of the VXX trade with the smallest losses possible. If we do pierce this line, we have probably, a new area that we're going to be looking into, and this is an area that's extremely concerning. And so I'd like to try to end up staying in my long VXX trade for as long as possible, but it's really going to end up being the culmination of these factors that end up determining. What I wanted to end up showing you is the following. Let me come one other thing I just want to end up bringing you. Okay, this is my trade window that I look at. And let me come over to here because every time you move it, I have to take percentage price off. Okay. Okay. Here's an interesting thing, all right, is that we've basically been moving up, okay, pretty much all day. We opened up higher. We were up over 8 points on the futures when by the first bar after the opening bell. We've continued to move up. But if you take a look at where the VIX futures are, the VIX futures, by the way, the front month is the candlestick. The pink line is the second month. The VIX futures are moving sideways, right? We're not moving down. A little bit over the last, since we've started our presentation, because we've had this huge run up, but we're still higher, okay, than where we were in the beginning. When the VIX futures move in the opposite direction of the S&P, SPX, E-minis, whatever you want to end up measuring, it's many times it's because the VIX futures, it's the institutional guys are fearful. Okay, so even though we're running up, okay, and currently the VIX futures are up 12.5. The E-mini futures are up 12.5. The VIX futures are only down 0.75 points from yesterday. Okay, and they're up from the opening bell. I don't know. Is this the last push higher from the bulls before we end up, selling off, or are the bulls here to stay? You don't know until everything plays out. But what I will end up saying is that when I take a look at my VXX trade, VXX today is only down 0.6%. Right? Let me move this over and we take a look, and if we come in here and take a look at the 5-minute chart, okay, you can see that VXX actually moved up yesterday, which you'd kind of expect it. We opened up down, but we actually closed higher. Here we opened up down again, okay, but we've moved higher since the beginning of the day, but the market's rallied. And so it's this type of analysis, okay, that when I take a look at all my indicators, end up pointing out that things can end up looking to be, still wary about market pullbacks at this point. Okay, Tom, I think I'm at a good breaking point right now. I just wanted to end up kind of going through questions and answering things. The first one was that I saw that you ended up posting the EAB guys, and I ended up showing you this here. The EAB guys put out at least 2 reports a day on volatility. Plus, they also end up doing maybe 2 or 3 trades a month that they end up sending out. They've authorized us to actually sell their newsletter, okay, that they send out to an institutional client base. Let me give you a couple of examples of that, and then I'll get into your questions. Okay. Let me pull that up over here. Okay. Here was yesterday afternoon or this morning's email that came out, and I just took a quick snapshot of it. But it ends up showing you that there was heavy call buying in the front month VIX futures. They'll always have some standout trades where they end up thinking that these things end up having a lot to end up doing with the market. They also end up showing you where there's any large institutional bullish trades. They end up explaining, they tell you exactly what they were, what the contract size were. And so they're going to show you things that are usually thousands and thousands of contracts. And so there's obviously very institutional flow. They'll end up summarizing the bullish. They'll end up summarizing the bearish trades, and you get that every single morning. In the afternoon, you get their commentary. Okay, it usually comes out a little bit after lunch. They end up telling you what's going on in the market, what's happening with volatility, and all the different markets they look at. They also end up giving you how they end up measuring put skew over a 2-month window. looking 2 months out. They'll end up measuring everything in standard deviations. When I quote to you guys, okay, skew is up or skew is down, and I think about it in standard deviations, it ends up giving it to the S&P, the Russell, the NASDAQ, and the Treasuries. It shows you where it was yesterday. It shows you where it is today. And then it also ends up showing you what the volatility changed. And then you get a midday report on what's flowing in terms of large trades. You also end up getting their current hedging strategy. They end up having a summary over the last year of when they've changed their hedging strategy and what they're using. And then you end up getting opportunities in and around any earnings plays. They'll end up talking about how they'll end up setting up certain ratio spreads depending on how expensive implied volatility is in 1 month versus another, where the put skew is. So you'll end up always getting, some trades that they end up putting in. And then you end up getting basically an earnings report where they end up showing what the expected moves are, what historical moves are, where things are in versus the implied volatility versus the realized volatility going over the last 12 earnings cycles. And so you get that. And then the last thing they end up getting is, I just wanted to give you another example of a midday report from a few days ago where and it's just the same type of thing where they'll end up having their trades. But these come out every single day. The other thing that ends up coming out, and the one that I missed, was the following. What they end up giving you is basically their summary of if they have any earnings plays. They'll end up going through. In this case, this was from the 19th, so it was from yesterday. Colgate, Palmolive, they'll end up talking about, if you're bullish, okay, is a much better way to go bullish into the earnings report is to end up buying this call spread, okay, and then selling, okay, the cash secured puts. They'll go through and they'll map everything out. They'll end up telling you what their logic behind their trade is. They'll give you all of the graphs of where the pricing is. They'll end up giving you the implied put skew of what things are, where they are, both in the IV and the skew, and that's it. So, and I'd say 2 to 4 trades a month they end up doing this. Now there is no support with this. You can't call them up and end up doing this. If you're an institution and you plan on buying 1,000 contracts, yes, I can get you an introduction. But if you're not going to be an institution, okay, to them, it's just their newsletter that they send out to their institutional guys. And I thought that if we could end up getting you an institutional newsletter of this quality and be able to end up giving it to you for $79 a month, I just thought that, I had to take advantage of that opportunity. I look at it all the time. I usually don't trade the individual stocks, but I look at their summary, their hedging strategy, and their skew and their IV analysis all the time. I think it's probably, one of the best things. It's one of the things that I have to end up reading every day. Okay. Tom has put together a couple places where if you're interested, you can end up, clicking on that. And Tom, before we end, if you'll end up also just giving them the URLs. Let's go to questions. Okay. Do I have the amounts, for the 2 components contributed to the VolVantage system? Yes, I do. Okay. Here are the statistics from the modeling, not the backtesting curve fit, but the modeling that we've done going back after we ended up modeling it. We said, well, then how did the model actually perform? You can see the results of VolVantage, by month. You can see the annual returns going back to 2008. Because I'm only buying or selling the ETF and not using the options, even though the ETFs and ETNs didn't come around until the end of 2009, for many of them the end of 2010 onward, I actually have the statistics going back before that. Why? Because when I was working with EAB and I was working with another institutional company started also by ex-Goldman guys, we actually had PhD quants where we ended up reading through all of the maths in the prospectuses. We recreated what the pricing would have been going back to when the VIX futures first started to trade at the end of May. April was the first full month, and we ended up creating, okay, what the indexes would have been, and then we ended up applying what we ended up learning, okay, on our different systems going back. Okay, and so that's why, we ended up modeling it. So because we looked at how we ended up performing in different areas, we'd end up testing small periods of time. We also ended up building our model of taking, arbitrary months, okay, throughout, over these past 13 years, and just choosing arbitrary, 30 days, calendar days, to see how we end up doing, just putting in month after month after month. And that's when we ended up changing a lot of the way we ended up using our 21 trading disciplines. And we actually we used 5 different indicators. So here's what we ended up finding, what you ended up asking. The contribution is that you can see that 50% of the time we were in the XIV trade. You can see that our winning percentages were 63% of the trades we won. You can see our average trades were about 21%. Our average losses were 4.4. Our average time in the trade was 21.4 days. You can see our largest gain and our largest loss. In the VXX, okay, we're only in the trade 11% of the time. Okay, with the current model. Doesn't mean that's going to be true going forward, but it kind of has been, okay, recently. When we ended up getting into the trade a couple of days ago, we got our first signal to go into the VXX in a year and a half. Okay, that's why I got really concerned when we ended up having our first signal to get into the VXX, and we didn't get it through. February of last year. We didn't get it through Brexit. We didn't get it through the U.S. elections, but we got it now. Okay, and this is the same signal that ended up producing these types of results. Okay, and so that's why I have a lot of fear and trepidation in and around being long the market. And I know that we're running up and having this huge up day right now, but you also notice that my VXX trade isn't getting hurt as bad as you would normally think it would be today. Okay, that fear in the VIX, okay, and the way we end up measuring our indicators is showing that there is real fear in the market. Have I ever considered trading the front and the second month VIX options contracts themselves? Okay, yeah, I have. Not only have I considered doing it, but I spent probably about 4 years considering it. I built out systems with both EAB and another company that I mentioned. And what ended up happening is both times when we ended up trying this, we ended up going into some pretty major changes of the way the VIX futures trade, the way their term structure looks, the way the options on the VIXs are traded, and then the ETFs and ETNs had the biggest thing on it. What I wanted to end up doing here is I wanted to end up making a simple system that anybody could trade. Okay, you didn't need to be an options trader, you didn't need to be a futures trader. If you wanted to do this in your mother's IRA, you could. Okay, and so yeah, I've considered it, and I went back to basically basics and said, hey, I'm just going to use these 2 ETNs. Okay, they're the most liquid ETNs of any of the VIX-based products. Let's end up using those. Next question. Do I mean they have to move in the same direction? On the VIX futures that I was just talking about, on this graph, yes, all the VIX futures will tend to end up moving in the same area, but they don't have to. When the front months are moving up quicker than the back months, that is when there is fear in the market. When they're all in unison and they're all moving sideways to down, that's when there's very little fear. So you can see just from the noise in here what happened with, I'm going to highlight, okay, the aqua color line here. Or the light blue colored line, you can see that it moved higher, but you can see that the front month, which was the blue, moved much higher. And so when you have a short-term option that moves at a different rate than a long-term option, that's when you know things are starting to change. You know, what's the best point of making the change, or when do you end up getting to a VXX trade? Um, that took me 4 years to answer that question. So that I'm not going to end up sharing, the specifics of why I ended up doing it. I'll just tell you that there was noise in it. We ended up getting in. We sent out signals. We ended up buying half of our shares, okay, on Tuesday, half of our shares on Wednesday of last week. And you can see that there's still a lot of noise going on here. Things tried to end up settling out, okay, because we thought that yesterday's move higher looked pretty good, but you can end up seeing here that it isn't the case. It isn't the case. Now, I do realize that we have French elections and there are other things that are going on. There's geopolitical risk, okay, in North Korea, and all of these things are what the fear is. If any of them play out, okay, the market can end up, taking a pretty big hit. If none of them play out, then the VXX is going to end up going down, and we'll end up getting out of it, not when the news event occurs, but when the VIX options and the VIX futures, when they end up dictating, we should end up getting out. Okay. Okay. And next question was Andrew talked about a trend line on the VXX. Okay, and let me start on that. Okay, because I have spent way too many hours on looking at trying to do technical analysis, on the VXX, the XIV, and the rest of them. And my conclusion is it's useless. Trend lines don't work. Oscillators don't work. Support levels don't work. All of these things are being driven by the VIX futures. Now, there is a tremendous amount of buying pressure. Don't get me wrong. This is one of these things. Is the dog wagging the tail, or vice versa? Because you end up having over 50 million shares of the VXX being traded on a daily basis. 50 million, 150 million shares is 500,000 contracts, and you take a look at who owns these things. They're traded a lot by institutions, but they're also traded a lot by individuals. And when they're traded by individuals, they tend to end up just getting whipsawed a lot. It's very difficult. You can't compete against the high-frequency trading guys. I know of one high-frequency trading firm for sure, and I have two others that I have confirmation from articles, but I don't have confirmation that it's the way I have proof of the other one, that the contracts that the high frequency trading firms trade the most is the VX contracts, VX futures, VX options, and the VX based ETF and ETNs. They trade them against one another, and it makes sense, right? Because they're the lowest price, and they're the ones that move the greatest percentage. So when you take a look at, they care about their return on capital. You're going to end up wanting to put your money in that has the lowest margin requirements, has the greatest possibility to move as a percentage, and that's the VX contracts. And so they tend to end up moving a lot, but doing technical analysis on it doesn't end up working. Next question was that the NX is also a little bit lagging the ES move up yesterday. Yeah, it was. If you take a look at the E-minis and you take a look at the Dow Jones, there was also changes in those. But what I'd like you to end up focusing on here is that when I take a look at these numbers, okay, I want you to notice that the SPY, and they use a SPY, and it's going to be the same in the SPX, but this is still nearly one standard deviation above the money, while the others actually are below the zero standard deviation line. What's happened is that the VX products tend to end up messing with our put skew much greater in the SPY than in the other products. There isn't the institutional involvement in the puts far below the money in IWM that there is in the S&P 500. And so they tend to end up having their skew be more like the way you used to trade, okay, and not the way that the SPY and these products are now trading. And so you need to end up realizing that when you're trading. Okay. How long has the model been live? I can't share with you how long I've traded the model live outside of capital discussions. It hasn't been back to 2000 and I guess 11 when I started doing the work. This model's been alive for a much shorter period than that. What I can share with you is that the model's been live since the 22nd of November. And let me see if I have this here. I can show you the trades that we've done live. Okay, let me come over to here. Okay. You can see I end up having trading shares, okay, and if I have long shares, I'll end up putting in the numbers. But I basically have had two core trades, okay. The one trade was this trade right here, where we got in on the 22nd of November, got out on the 24th. You can end up seeing that the VXX trade, we're actually down. I haven't updated this. We're down about actually a little bit more right now, okay, because the market's continuing to move up. But when we started, I was down about 1.25%. On this trade, I can end up telling you that the VXX trades, that more than half of them last 7 trading days or less. We're in our 7th trading day today. 6th for the second bunch of shares, because I bought my second bunch of shares on the 12th. And if the market continues to end up going, we will have to end up shutting down our trade. When we get into IV trades, they tend to end up being longer. You saw on this chart that the average days in the trade is significantly longer in the XIV than the average number of trades in the VXX. You can see that our winning percentage is also greater, okay, on the XIV trades, but the VXX trades have the ability, if we do catch them, to just have huge profits. Does it happen very often? No. Okay, the markets don't crash that often, but the VXX system tends to end up getting into the trade once we have real edge in our trade, but before the market starts to end up really tanking, to be able to catch the meaty part of that VXX jump when it ended up moving so high. Okay, next trade. They were looking at the different presentations in performance. Okay, of the performance charts, and notice that the monthly year is a difference, okay, on June 13th. Okay, why is that? June 13th. June 13th. I don't know what you're asking. We were down that month. Okay, what ended up happening is that there were different models that I ended up using. Okay, we'll end up modifying, okay, them. And if you take a look at this, the actual performance, okay, was lower here than some of the ones that I've used in the past. It was higher than the lowest one that I've shared with you before. So if you've looked at other ones, it was previous ones that we were playing with. This is the one that's currently being traded. What I will end up commenting on, though, is I have shared this with a couple of large RIAs, and I shared it with my in volatility trading buddies that I know at the two firms that I ended up mentioning. And I also ended up sharing it with the chief technology officer of a Fortune 500 company that's a finance company. And several of them have asked me what happened in 2013, 14, and 15. Why was my performance so bad during these 3 years? which we laughed. And I said, if you don't mind, let me rephrase your question. You want to know why my performance was so bad, why my VolVantage system only averaged 21.4% during these 3 years. Okay, is that what you're asking me? Why it was so poor at 21.4%? And they would end up laughing and they'd say yes. Um, it wasn't until I got with the EAB guys and the other institutional option guys, and we did some more research, that I realized why it was so bad. These were the 3 years where the high frequency guys, okay, and the computer algo guys were getting into the options market, getting into trading the VIX, okay, options, the VIX futures, the VIX-based products. It's when our skew started to end up changing, pretty dramatically to the way it is now. And as they were getting in, what ended up happening is that we search for, I use the term elephant footprints. When the institutions move in or out of a trade, you can see it with the speed at which things move, the volumes at which things trade, and they were all getting into this over a period of time. And it was during this time where my elephant footprints weren't as clean as they were beforehand, when they just traded without the algos, or it wasn't as clean as after they all got in, because now all the algos again are going to end up being more similar. So it's basically tracking the big money on Wall Street. And when we went from, if you will, the old guard, okay, beforehand, to the new guard now, the new guard being the computer trading, the algos and the high frequency guys, as we went through that change, we got whipsawed more because we couldn't end up seeing as clear, on the indicators. But still, let's, reiterate, okay, why was the performance so bad while it only ended up producing, 21.4% average over a 3-year period? You know what? That's a great question to end up asking, right? Right? Why is my performance so bad at 21%? But that was the reason. Now, the challenge, right? The challenge that many of you have had, okay, as options traders, what was working, okay, stopped working for you. And during these 3 years, okay, your trading had to end up changing pretty dramatically. I had been asked, was 2016, and I know there was a whole forum, why was 2016 such a difficult trading year? And it wasn't, if you had realized, okay, these changes had taken place. If you were still trying to trade your old strategies that worked in different places, of course you got killed in 2016. But if you realized that 2016 was going to be a great year, very important here. Okay, what I've done is that we've looked at different patterns, how things have traded, and remember, I'm using 5 different indicators. Okay, we're using an adaptive trading system that'll handle 21 different trading environments. And so, yes, okay, we've seen, okay, those changes in patterns, and I'm constantly looking at it. I wouldn't be surprised if there'll be another one over the next year or two, okay, that we'll put in another, we'll realize more trading patterns, and then we'll go in and we'll see if that ends up making any sense. But if you don't have 2007, 8, and 9 data, and you try to end up building a system, or if you didn't realize that these things were changing as they were changing, while you were trading this thing, you got absolutely killed, right? Absolutely killed. Okay. Couple of other things. How do I know that my service compares VIX? Right. Let me read that again. If you know how your service does against VIX Tango service. I don't know VIX Tango service, but let me end up seeing if I can end up pulling this up here. Okay. Was it this or was it this? Oh, here it is. Okay. It's this one. Give me a second. I got this. So what I did was that I went back and I said, you know what? I don't need any trading service. What I'm going to do is that I'm just going to end up buying, okay, I'm just going to end up buying the VXX when we're in backwardation, and I'll end up buying the XIV when we're in contango. Okay. And what I did was that I went out and I took a look at a 9-quarter period. Okay. Um, by looking at the 9 quarters, I chose 9 quarters, but I didn't look at the maximum drawdown of any single trade, which would have been, or any single month, okay, using that. Um, and I had this period in here. But by the way, I still used my trading rules. I still tried to use my trading rules, but it had a drawdown of 62%. It had losing trade, losing trade, losing trade. And I also made sure I eliminated and I didn't use the 3 worst months. And not using the worst 3 months and not using the period that had the single largest drawdown, these were the results that I got during these 9 quarters. Okay, down 50%. Now, some of you may have used other services that had to redo their strategy because they weren't able to end up testing back to 2004. They didn't have an adaptive system that used 5 different indicators. They didn't build out 21 different trading scenarios. And so what they end up doing is that, oh, we missed that one, and then they had to go and rebuild it. You know, I feel pretty comfortable that we looked at a lot of things. Remember, I did this with 2 different companies, started by ex-Goldman options guys who ended up having their own quants. Okay, we've really looked at this in great, great detail, and I'm pretty comfortable that we've, seen the changing of the old guard to the new guard. We've seen the old strategies, the new strategies. We've seen them as they ended up implementing them, and I feel pretty comfortable that, yeah, I'm going to have losing trades. Okay, the VXX trade right now is probably going to end up being a losing trade that we're in, but I'm also comfortable that it's going to end up being, relatively minor compared to the 59% we made on our core trade that we closed last month. Okay. Do I trade midday, open, or the close? Okay, very good questions. How much lead time do I give subscribers? Well, let me end up showing you. Okay, let me come over to, where do I have it? There we go. Was this it? No. Okay. Here's my trading notes, okay, from, let me hit refresh. Okay, here are my trading notes, okay, that I end up putting at the opening bell. Here are my trading notes that I put on the 17th about what I ended up doing. And so I'll end up giving you trading notes, okay, whenever I put on a trade or whenever I'm considering a trade, okay, beforehand. They end up coming out. I'll leave them on for several days. If you take a look at what I end up sending out, if I show you trade images, when I have a trade on, you'll end up getting an update every single day. I'll end up explaining, I'll put on, different charts to end up explaining what I'm doing, why it's doing. I won't share what the actual indicators are, but I'll at least explain to you, okay, why I'm doing stuff. You can end up seeing here that I'll end up, when I don't have a trade on, I'll update once in a while, not often. Here was the day when we ended up closing, okay, our our XIV trade. I closed our trading shares, which were only 100. Our core shares were 800. And so I'll end up putting in what's on. It ended up saying right here how we ended up closing our trade. Our core shares were only up 17. I'm sorry, our core shares were up 58.5. Our trading shares only made 17%, okay, because we are entering them much later. And so I think that you don't get just an index. You get an index, but me explaining to you why things are happening. Okay, and I think that that's a pretty reasonable way to be able to do that. You'll end up seeing that I'll send out, when I send out messages, I'll end up explaining what we're doing. I'll tell you how many shares, and I also give you the Thinkorswim actual order. So if you wanted to copy and paste that into your Thinkorswim system, you could. Do I close at the beginning or the ending of the day? Because I only had ending day pricing, okay, going back to 2004, right? Because I had to calculate what the prices were. So from 2009 through 2004, I only have end of day pricing. The system is built on end of day pricing. Having said that, what I've been doing is that I do trade, okay, but usually only during the last hour of the day. Yesterday was a great example where I ended up writing to everybody that right here, okay, that I told them pre-market that, hey, if the VXX doesn't end up helping our VolVantage indicators by the end of the day, I will be closing the trade today. And so I think that people get, more than a fair share warning. Plus, also, by the way, unlike any option service, it's not like you have to go out and buy, some four-legged option that you have to end up working the order. Here, you're buying a liquid ETN that's trading, 20 to 50 million shares a day. It's not that difficult to end up getting on a few hundred shares. Okay, next question. In the backtesting modeling results that I'm showing, okay, what is the trigger, okay, for long or going cash? Andy, that's what I said I'm not going to end up sharing. I'm not going to end up sharing, okay, what the triggers are. The triggers are can be any one of the 5 indicators, and then the trading rules, okay, encompass 21 different trading scenarios. Even if I wanted to end up sharing them with you, it would take me, a half a day to end up explaining everything. I talked about the bad performance because the indicators were not clear. Do you think that accounted for the good performance in 2016? The high-frequency guys are still there. No. What ended up happening is that not all of the high-frequency guys were there now. They weren't the ones who were driving the market. The big, the cash guys who were trying to do this by hand were still, they were still thinking that they could push around, okay, the high frequency guys. And so this was a battle. What I would end up saying, what happened during these years, this is the old guard, the way things used to end up working when you'd have the, the guys sitting upstairs, okay, at, Goldman or Citadel or wherever. And when they then automated everything, this was the period of 3 years where they were automating everything and they were getting the computers to trade, and there was a battle between the high frequency guys and taking ownership. And then this is, okay, now everything's back to, a single leader, and that is it's the computer-based guys, right? It's the high frequency guys, it's the algo traders. And so what I end up believing is that they are all very, very smart. Their trades, okay, these guys are brilliant they're all PhDs, right? They're physicists, mathematicians, and econometrics guys. And they move from one firm to the other. And so that the high frequency guys have become more homogenous, right? They're much closer, okay, to one versus the other. And it was a 3-year settling out period. We ended up getting things kind of settled out in 2016, and now they're all trading alike again. What will end up happening, because they're all now have great systems where they're reading one another, as soon as somebody makes a trade in one place, you'll see this, by the way. You'll watch how the bids and the asks all change, and they're all watching one another. So if one guy makes it and one guy has a good idea, they're going to continue to end up going on it. So do I expect we're going to have continued good performance? And by the way, bad performance again was 21% a year. But are we going to have better performance than that going forward? I don't see why not. We have taken into account, like I said, much more than anybody that I've ever talked to. 5 different indicators, 21 different trading scenarios. It's pretty robust what we've built. Okay. Next, okay, that was the bad performance 2008. Okay. How important is the concept of trading shares versus core shares? It's not important at all. Okay. My system here is only talking about core shares. Okay. And that's what I want to talk about. I'm always going to talk about core shares. Now, here's the problem, okay? I've been asked many times about what happens with drawdowns. Okay, what happens with drawdowns? And let me bring this over to here so you can see this. The blue is the maximum drawdowns that the system has ever had. Okay, and that is getting in, not counting what day you go in and what day you go out. It's going in on any single day. And so the maximum drawdowns that you end up seeing are going in at the absolute high mid-trade and getting out of the trade mid-trade, okay? That's the absolute worst, okay? If you take a look at the red bars, this is only starting, okay, when you get a trigger to start, okay? And what's the maximum drawdown then? And you'll see that the maximum drawdowns, by the way, happened in 2008, a year that we did 200%, by the way. Yes, there was, a couple of trades that ended up losing money, but there were a lot that made a lot of money during that time. If you end up taking a look at most of the drawdowns tend to end up being, 10% or under the maximum drawdowns. We haven't had a drawdown, more than like 10.5% going back to 2010. And before that, the only one that we've had over 15% was in 2008. And so I think it's very important that you don't just start it at any point. And so the concept of core shares, and let me just move this back out of the way. The concept of core shares was here. And do I have it? I don't, so let me just pull up the XIV trade. Okay. Instead of me having to answer the question, is now a good time to get in? Is now a good time to get in? What I ended up doing was that I actually ended up putting in, okay, I bought trading shares with you. I used all of my capital and then some. And then I had another trading opportunity to buy over here. And so I sent out the email because what ended up happening, quite frankly, is that some of my Kevlar subscribers, okay, when I started to send these things out here, several of them got out here, okay, a couple of weeks later. Many of them got out here because we started to sell off. And when I ended up selling trading shares here, I didn't tell, I just told, I bought extra shares because I day traded in there and I shouldn't. But I ended up saying, well, I kept getting asked, when's a good time to get in? When's a good time to get in? So I'll end up giving you, during the life of a trade, I'll end up telling you, now's a good time to end up adding shares. We've had an opportunity where we've had a sell-off, but our indicators still look strong. Okay. Yes, sometimes when you have these pullbacks, the indicators weaken, and then you have to end up getting out. And yes, that does mean that I'll usually get out, giving up, 5 or 10% from the top. But I kind of take a look at what happens if I got out at this top. I would have been a loser. What happens if I got out over here? I would have been a loser. What happens if I got out over here? I would have been a loser. So the problem is that you'll probably go through 3 or 4 of these things where you'll have shorter term tops only to have the market continue to end up, increasing. What normally happens when I end up getting out of a trade over here, when I ended up getting out of the trade on this day, even though we ended up selling off a fair bit, right? I looked like a complete idiot for 3 days. But this was the high frequency and computer guys showing their hand. Okay. Yes, they tried to end up taking, having the market go up and things seemed to be good, but then we started to end up having the sell-off again. Okay. And you can end up seeing that the S&P started its sell-off. Okay. We hit our high on the 1st, March 1st. Well, look at what happened on March 1st. Look at where we were here. This was the high of the S&P. That's not a good day to get, to end up, getting out of the trade. Look at how much higher it ended up going. Look at how much higher we got out at. Believe me, I have tested and modeled this thing for, 20,000 hours, of man effort, I've put into this thing. We've looked at every scenario, Is it going to be right sometimes? Yes. It's going to be wrong sometimes, yes. I know I'm going to be right more than I'm wrong. I know that I've built these things so that my trading losses, should end up being, significantly less than my winners. And that being said, this is the performance that I've had, and you can end up seeing the winning percentages. I'm not trying to win every trade. You can't. I'm not trying to get out at the top. You can't. I can't get in at the bottoms. I'm just trying to end up riding the meaty part of the curve, The meaty part of the curve to try to end up making our winning trades to be, decent, okay, and to be significantly higher than our losing trades. My winners are 5 times on average bigger than my losers, and I have a winning percent of trades. Okay, I'm pretty happy with that. More questions, and Tom, I know we're way over, but I'm just right. We're all done, by the way, except for the questions and answers. Tom will end up having both in the chat. He's put how you can end up signing up, and at the very end, Tom, maybe we'll break this out so people can just see how to end up signing up when you end up going through that. Next question. Am I concerned that with so many different indicators and over 20 environments that I've typed that I have curve fitted? No. Okay. What I've done, okay, in terms of curve fitting is that we have built the system on logic first. We've then ended up running extensive tests, okay, on a year period. We would then end up taking our set of rules and we would randomly choose 30 calendar days in a row to be able to end up running our system on this versus that, and we would end up seeing where our losses were. No, it's not curve fit, it's robust. Okay, what curve fit means the following, and I can change the parameters. Okay, I can change the parameters on my trading rules, and I can end up showing well over 130, 140% a year. We didn't do that because what ended up happening was that it didn't end up providing the risk-reward ratios, okay, that we wanted to end up having. It didn't end up providing the potential risk that we would end up having to stay in trades longer. I didn't end up getting out of trades sooner, okay, because if we end up clamping down on our risk management parameters in our trading environments, it ends up clamping down and really shuts down performance. So what we've done is that we've given the trades enough room to run that as long as the indicators are still in the same direction, they're still bullish or bearish, okay, we're going to end up letting the trades run, and only when our signals end up telling us so. Now, yes, there are some trading rules that we end up putting in place that, when do you end up taking profits? Do you ever end up stopping yourself out? Do you use trailing stops? We've used some of those only to end up curbing what could have been, significant losses. However, any of our trading rules were only applied at the end of the day. So if that meant that we went through a stop, okay, at the open and we continued to end up selling off all day, that meant I took the full day loss. Okay, here's a great example. Okay, I could end up curve fitting things a lot, but in September of 2008, okay, the system that we ended up wanting and we ended up going with is that our system didn't end up buying VXX until the close on Monday after the September 12th weekend. Remember, December 12th was the Friday. That was the weekend when the Fed met with all the CEOs and all of the big banks, and they were deciding, okay, who was going to live and die, and they shut down Lehman. Okay, and if you were trading on that day on Monday, I'm pretty sure you were hiding under your desk because I know I was, and we didn't end up buying, okay, the VXX until the close that day. Okay, it's not like you would have said, oh, well, you jumped into it early. No. If I end up curve fitting that month goes over 100%. Okay, so no, we did not curve fit at all, because what ended up happening is if we would have curve fit and we took a look at what would have happened there were other scenarios where, we're going to get into trades a little bit too early on certain things, and the way things ended up working. And so it was the opposite of curve fit. If anything, the system is far detuned from what a curve fit, okay, could have happened. Okay. What we ended up doing is that we went for more consistency. Okay, we went for much more consistency and safety. Tom, that's pretty much it for the questions. I don't think I missed any. I don't know if Tom is still there or not. So let me end up just sharing this with you guys. He may have had to end up going. I don't have it spelled out, but here are the websites so that you guys, if you want to end up seeing it, that you can click on any of these. Our short URL is cd, capital discussions, URL.us. and you can end up taking a look at the annual, okay, EAB letter. It's just called EAB annual. You can take a look at the monthly one. It's called EAB monthly. And the VolVantage is going to be going out over the weekend, the actual signing up. If you want to get all the information delivered to you so you don't have to look for it, just go to the URL VV Interested, okay, for VolVantage Interested. Those are the websites. And if they're...
Jim, can you hear me?
I can now, yeah.
Oh, good. I changed my IP address, and then the audio didn't work, so I'm back. So
okay.
I have the links on the recording in the library already. So when I publish that, the links will be there. So don't worry if you don't have them now; they'll be on the recording on the library page.
Okay. Sorry I went so long, but I was answering questions for the last half hour.
Oh yeah, I was there. I just the little audio problem, but
okay. Tom, any questions? I mean, you and I have talked about this. I've shown you some stuff, but any questions that you either have or you had that you found interesting when we discussed them?
Well, I mean, it's a nice, robust system that's kind of complementary to almost any option strategy, road trip, Kevlar, you name it. So it's a nice addition to a portfolio for diversification.
It really is. You know, two comments I'll end up making. And the first one is that the reason why I ended up building this was that my Kevlar struggled when we have these moves up that are just constant. It just keeps going up and up and up and up. And I know that road trip doesn't make as much money. I know M3 doesn't make it. I mean, when you have these, you know, unidirectional markets, you can end up having some challenges. This system, as you saw, what we've done from after the election till we closed the trade in March, you know, it was up 59%. So it's a wonderful complement to a lot of systems. The other thing is that if we absolutely tank, okay, we tend to end up being in the VXX, okay, before we tank. And so if we absolutely tank and that ends up hurting your options trade, this does well. Tom, you and I spoke about this. Tom and I felt so strongly, and I felt so strongly about this, is that for my Kevlar subscribers, okay, they're going to get this for free until the end of June. After that, they get a 50% discount, 50. I didn't want to end up leaving out to the other subscribers for the other services. So if you subscribe to, you know, Tom and Dan's service, or you subscribe to the Fruit Fly or the Rhino or anything else, you get a 25% discount as long as you're a subscriber to another service. Okay, we're only going to end up selling this in annual subscriptions, and the reason why we're going to end up selling it in annual subscriptions is that I get too many times people end up saying, well, you know, I don't think we should be in cash here and we should go here. No. This is the system, the way it's worked. This is what's worked the best. You need to give it a little bit of time for the trades to play out. And so we think that the annual return on this thing has been absolutely great. And there isn't a 12-month period where in our modeling we've lost money. And so we've decided we're going to end up doing this only in annual subscriptions. The last thing, and Tom, I didn't share this with everybody else, but the last thing that I think is actually, you know, really important here is that, you know, when we take a look at this, let me just bring up one slide I wanted to end up showing you. Okay, I've started talking to professional money managers, and this is not the slide. That was the old slide. Professional money managers on this, and the key, was it back here? No, I have it here. Give me 1 second. I'm in the wrong one. Let me try this one more time because I never shut down the other presentation. That's what ended up happening. Okay. The key was that a registered investment advisor, if you have your money with a investment advisor or a portfolio manager, okay, the key to this, and you have the same issues if you're running your own portfolio, okay, people fire their RIAs for one of two reasons. They lost too much money in a bear market, or they didn't perform well enough in a bull market. Okay, if you take a look at the performance and you match this against the S&P, what you end up finding is that this is almost like a long gamma trade. As options traders, right, we collect data. What's our enemy? Our enemy is gamma. If things keep moving in one direction, they keep going and going and going and going. Okay, the longer you go in one direction, the more money this trade makes. I mean, I don't want to end up saying it's a great hedge, okay, for any options trade, okay, and that's the only thing it's good for, but it does have this long gamma characteristics, and even if the market isn't moving, yeah, we get chopped up sometimes. Yeah, we end up having pullbacks, okay, but, our largest drawdowns are usually, reasonably contained. And so. Anyway, so that was it. Tom, anything else from your side, or you can think of any questions you've been asked, or?
No, I think you covered it pretty well, Jim.
Okay, guys. Thank you so much. Sorry we went longer, but I wanted to make sure that you guys had all the information on this. If you end up sending out, just click on the link, okay, in the library, okay, to VV interested on our URL. Tom will make sure that you get all of the information. The information will be sent out over the weekend, and I won't be having this sent out to everybody or free after that. Thanks, everyone.
Thanks, Jim.